All right, so this is Valero. This will be a valuation of the stock price before we purchase more shares. I definitely wanted to get a good understanding of exactly what the company is worth so that we don't end up paying too much. Um, Previously, I should say currently, Valero is not doing so well as far as earnings and profit goes. But it's a decent company, largest oil refiner in the United States, one of the largest, if not the largest. And they're also exporting a lot of gasoline to Latin America as well. And so they are reporting that things are picking up, things are getting better. This previous quarter, June 2021, they did finally report a profit. That has not been the case previously, and so again, just want to take a look at what we're doing here. So first thing you'll see here is assets. I do want to make a quick disclosure on that because if you have followed me before, you know that I don't typically include depreciation and amortization in my calculations for assets. The other thing too is I never want to assume that if this company were to sell on the open market, that they will be able to actually get 100% of their money back for whatever assets it is that they're selling. So, of course, um, revenues went into the calculation, um, and then oh wait, this is income. I know revenue sounded weird. There we go. Okay, so of course, cash went into the calculation, receivables, inventories. I left out prepaid expense. The reason why is because we have to assume that, again, if this company is sold on the open market, those expenses that they've already paid, they're not going to be able to recoup, right? I mean, maybe they'll be able to recoup some, but I don't expect them to recoup any, if at all. And then deferred charges, other assets. I didn't dive really deep into what that stuff was. I just assumed it was correct. Okay. And then as far as liabilities go, I went ahead and included everything in there. Um, the Okay, and then the other thing I just want to quickly talk about are the common shares. So, as you see here on the balance sheet, there are 673 million shares issued, but 265 million are treasury. And so, what that means is that they have purchased these shares, and now they own these shares. They haven't retired them, but I included it in the calculation because the company does have the option to sell these shares again in the open market at whatever price they can get for them, right? So we assume that it's the current price, but who knows really? All right. So that's that. And so what I got based on those numbers, again, using a conservative estimate, assuming that, again, everything is sold on the open market, I discounted everything 50%. So 50% inventories, 50% of plant, utilities, and equipment. I say utilities, plants, facilities, and equipment. And then 50% of accounts receivable as well. Okay, again, just a conservative estimate. And what I got was $2.88 per share. Okay, is what they'll be able to get. And then, of course, we add a multiplier for that because of, again, anything that you sell, you're going to, you're going to profit, right? And so we know that the price to book is the ratio that's used to multiply basically how much the company owns versus what the stock price is. Okay, so it's a very simple calculation. It's simply price at the top of the divider, and then the book value at the bottom. And so what I did was I grabbed three different price to books based on historical numbers, right? So the lowest price to book ratio that Valero has seen in the last 3 or 4 years was 1.2. Currently, it's at 1.5, and the highest has been again in the last 3 or 4 years. It was like 1.9, but it actually hit that number twice. It was like 1.96 one year and 1.82 another year. So I just kind of averaged it out at 1.85. Now, understand that currently, again, the price to book is 1.5. The competitors in the industry are about the same. There is one for the name that was like at a 0.98, and then there was another one at 1.2. Everybody else is right in line with where Valero is. So again, we assume price to book at 1.5. That gives us a stock price of $4.30. Again, conservatively, basically, this is if the company were to go bankrupt, okay? And then on the high end, 1.85 gives us a price of $5.32. Now, for the moderate calculation, I used basically a quarter. So, no, not a quarter, 3/4, sorry. So 75% of plant, 75% of assets, 75% of inventory, okay? And then again, I used all of the liability, again, because we want to stay conservative on this thing, all right? And that gave us a stock price of $31.65. Once we add our multiplier, we get $37.98, $47, and $58, all right? Now, I did use actual numbers, okay? I did take out depreciation and amortization for, again, those plant facilities and equipment. Reason being is that I have to assume that, again, if this company is sold on the open market, the balance sheet that they've reported to the SEC and the general public is correct, and those assets are actually worth what they say they are worth, okay? And so that's why I named this part actual. So these are the actual numbers as reported by the company, all right? And so what we get is a stock price of $44.41. We add our multiplier to that. On the low end, we got $53. Currently, right now, the stock price is actually a bit undervalued because the stock is at $64, and I'm showing a price of 66. So the stock price based on this is a bit undervalued. And then on the high end, we have $82. Now, I also did look at the income statement on this thing. Price to earnings is what I used here. Now, I have to discuss this because this is a weird thing, all right? So, like I said before, Valero has not made a profit in the last, I think, like 2 years or something like that. And so price to earnings, okay, that ratio means price is at the top of the divider and then earnings are at the bottom. Well, if your earnings are negative, then you can't have a PE ratio. You can't have a price to earnings. You can't have a negative price to earnings. Negative price to earnings would mean that the stock price is zero, right? And that's not the case. We know the stock price is not zero. We know that people are more than willing to pay good money for a share of Valero stock. Even though the company is losing money, it still has value in the open market. So what I did was I kind of came up with my own calculation. I want to show you kind of how I came about that. So first off, looking at Morningstar, which I consider, a reputable source, right? They currently have price to earnings at 13, okay? And they are sure, get rid of this. All right, and they were sure to list this as forward earnings, okay? Forward earnings. What that means is that this is some sort of guesstimate as to what the earnings will be, all right? And they have that listed at 13. And I want to compare that to, this is it, no? I think this one is it. This is NASDAQ.com, again, reputable source. They're showing the PE ratio at negative 20.74, okay? Again, this is just a straight up math calculation that they're using, right? And because the company has had negative earnings, then of course the PE ratio will be negative. But like I said, you cannot have a negative PE. It's just, it doesn't work that way, right? But what's interesting is they do show their year's estimates. Okay, so we have 2021 estimate, 2022, and 2023. Again, this is a straight math calculation, so the 2021 estimate is not correct. All right, that's just a crazy number. It'll never get there, I promise you. But the 22 and the 23, again, this is based on a guesstimate of what the earnings can be. All right, and they show it at right around 12 or 11. So let's now take a look at mine. So this is what I did. Okay, so I pulled out the earnings, and what I did with this is I took out. Let me show you. I took out again depreciation and amortization, because depreciation and amortization is not a real expense. Okay, it's not. It's just depreciation and amortization is more of a tax thing, right? So you make money, you depreciate asset that you own, that reduces your profit, you pay less tax, all right? But it's not a real actual dollar expense, okay? So what I did is I took, and again, I'm assuming that all these numbers are good. I didn't do a deep dive into things like other income and stuff like that. I just simply took the current net income, okay, which is the 62, okay, and then I subtracted the depreciation. I'm sorry, added back the depreciation and amortization to that, and actually, I used this number. Yeah, I use this number. So again, this is the 6 months ending 2021. Uh-oh. Got too happy on the street. All right, there we go. Yeah, 6 months ended 2021. So again, this is January through June 30, 2021. And the net income so far for the year is a negative 542 million. But when you add back the depreciation and amortization of 1100, all of a sudden you have a profit. And I noticed that going back over the last year, okay, I noticed that every single time they posted a loss, once you add back depreciation, all of a sudden they have a profit. And so what I did was I used the profit from the last 12 months in order to give me a current earnings number. All right, so last 12 months gives me a current earnings number. Okay, and then simply divide that by the number of shares, and that gives me $2.31 per share. All right, now that's the earnings per share part of it. All right, now what I then did is I took the current price, all right, and divided it by the current earnings that I calculated. That gave me a PE ratio of 28. Okay. Now, again, we're assuming that the market knows best. So if the current price is 64.70, that's what the company is valued at. That's just what it is. And that means that our PE ratio is 28. Price to earnings is 28. All right. So then what I did was looked historically at the PE ratio for the company, and I pulled out the lower end PE ratio, which is actually 7. And then and just to explain what I did here. So again, the PE ratio that Morningstar has come up with was like 13, right? And so, and actually, well, that's okay. Yeah, so was 16. We use 16. All right, 16. It's a different company. So anyway, the PE was 16, and so what I did was I basically just figured out the percentage difference between my PE ratio and the PE ratio that they came up with, and that's how I figured out the low end of 12 and the high end of 33. Okay, in actuality, the higher PE ratio for Valero was like 19, the low end was 7. Okay, but again, that's based on their calculation of earnings, not my calculation of earnings, which is why my PE is going to be different. But again, it's the same. It's relative. It's relative to the number, so it's the same. Okay, it's the same. All right. So anyway, based on all that, what I did was I pulled out the current price based on, again, the PE ratio as it stands. Okay, on the low end, 28, currently 64.70, on the high end, 76. All right. Again, just to explain, so PE ratio has to do with how much the market is willing to spend on a company. And a lot of that is based on the industry or sector itself, right? So, for instance, tomorrow, if everyone gets excited about oil and gas, all of a sudden you're going to have a lot of money coming in to oil and gas, which is going to raise the price, but the earnings stay the same, and that's going to increase the PE ratio. Okay. So a lot of times this is market sentiment. And that's the reason why, like I said, we're looking on the low end to the high end. So on the low end, if people are just saying this is just horrible sector, we should get out of it. No one should ever purchase Valero or any gasoline stocks or oil stocks. The lowest PE ratio that we've seen, like I said, would give us a stock price of $28 at current earnings. Okay, at current earnings. And then, like I said, on the high end, 76.83. Now, we do know that earnings do move around. Okay, earnings do move around. And let me show you some forecasts on that. Let's see. Is it this one? Yeah. All right. So this is analyst estimates of the earnings for Valero. Okay, so again, how they calculate their earnings is going to be a little different from what I did because again, I took out depreciation and amortization. Current, the estimate was 14 cents, high estimate 29 cents, and we see here next quarter, which is going to report in October. They're estimating 75 cents, 38 cents on the low end, $1.03 on the high end. So what that means is that these analysts are expecting the earnings to grow. Okay, they're expecting earnings to grow. And so again, coming back to my earnings estimate, okay, this is just a wide this is literally a standard deviation. Okay, so standard deviation it means that there's about a 75% chance, okay, that it will be on the high end or the low end. All right, it's a wide range. Just to give us an idea of where this thing can go. All right, so $42 on the low end for the PE, 97 at the current PE, and then 115 on the high end. If earnings fall, okay, if earnings fall, because that is also a possibility. If earnings fall by half of what they were this quarter, and just to go back, so you can see, again, we're showing low estimate of 38 cents, which is actually a penny less than what it is now, meaning that these analysts don't expect the earnings to fall at all, right? At all. Matter of fact, they expect earnings to increase to almost 3 times, or actually, yeah, more than 3 times the current earnings. And on average, they expect the earnings to grow by double. Another thing I wanted to point out here is the beats. Okay, that's on this one. There we go. Valero has a history of beating analyst estimates, and so we see that here. Earnings per share comes in at 48 cents. This is not right. Not right. Let me look at this one. Okay, this one doesn't show June. So that's what's going on. All right, but anyway, what you can see here, just more recently, right? The estimates are here, and the actual is the second row here. Let me blow this up. There you go. Valero has a history of beating the estimates, okay? And we see that here back in June of 2020. They beat, even though everyone was expecting them to lose money, they actually lost less than what everyone expected. Same thing happened in September, same thing happened in December, and then it happened again just recently in March. So again, we don't expect this to happen, okay? It's more than likely that we will have some middle ground between these two columns. What I did do though was I did a simple average across all of these numbers, just really kind of for fun, and it gave me a price of $56.61. Again, if we take out the low end, which again I'm sure we won't see, it gives us a price at about $70. So again, it shows that the current price is undervalued, right? So current price is $64.70. I have a price of about $70 currently. Okay. Same thing, like I said, price to book. We have a current price of roughly 66. And so let's take a quick look at what the market thinks about this. Sorry, I can't blow this up. I've tried many times. Let me see. There's just something. Let me. Yeah, there's just nothing that let me blow this up. But anyway, so I'll just talk about it. So these are the options, okay? This is expiration date of October 1st. So this is 1 month from today, roughly, all right? And so what this basically says is at $65, okay? At $65, someone will pay you $250, right? To purchase your no, I'm sorry. Someone will pay you 250 someone will pay you $250 to sell their shares to you at $65. Okay? So what that means is that someone will pay me $250 today, all right? And then on October 1st, if the price is below $62.50, I will purchase the shares from them at $65. Okay. And so as you see here, the number goes higher and higher and higher, the larger the number gets. And what this simply means is where the market itself, where do people think the current price is? And so whoever this person is, right, they're saying that it's possible that the price will actually get down to 60, was it $62.50 by October 1st. Okay. If we go out a little further, let's go out to $75. All right. Let's do a little bit of math here. So do 75 minus $10.35. Okay. And what this saying is that this person will pay you $1,000, okay, to sell their shares to you at $75 by October 1st. All right. And what this typically means is that they think that the price is currently $64.65. And the current price is $64.70. So it's right there. Okay. Now, of course, the risk is that if the price does drop to $64 by October 1st, you'll then have to purchase 100 shares of Valero at $75. If we go up to the $50 strike price, we see that the price is now zero. Okay, so no one is willing to sell their shares to you at $50, typically because no one thinks that the price is ever going to get down there. All right, that's the reason why there's no price, and that really goes back to the variance in stock price that we see that I calculated there. You know, $50 is way on the low end. Same thing here. If we wanted to sell our shares at $65, okay, someone is willing to pay $200 roughly, okay, to purchase our shares at $65. All right. And the only reason why they would do that is if they think that by October 1st, the price will go up to $67. All right. So let's go to the end of that range and let's see where the market thinks this price can go. And we see down here at the bottom, it gets down to zero at $80. So at $80, no one is willing to pay to purchase shares by October 1st because no one thinks the price is going to get there. Okay, but someone is willing to pay to purchase shares at $75. And again, the only reason why they would do that is if they think that the price is going to be higher than $75 by October 1st. And so just based on the options market, we can see that the price just within 1 month ranges between $50 to $80 roughly. Let's go out just a little bit further to fun here. And let's go out to let's go out to August of next year. Gonna give it to me? It's not gonna give it to me. Let's see, December. That's because I closed the other page. That's okay. Let's take a look at October 26th. I think this will be good enough for illustration. All right, so if we go out a little further, then all of a sudden the price range gets much further. So now we actually have a bit of price action at $45 because the longer time you have, the more the price can move around, right? So even at $85, someone is willing to pay something to purchase those shares. So again, it puts a price variance between $45 and $85 within only 2 months. Okay, if we do a little bit of math on this thing at let's say 75, again they're willing to pay about the same thing, about $1,000 to sell. I get so confused with this. They'll pay $1,000 to purchase. To sell their shares at $75. There we go. They'll pay $1,000 to sell their shares at $75. Okay, but again, they'll only do that if they expect that the price actually drop by more than $10 come October 22nd, and that would put the price at right about $65. So if the price does not move between here and October 22nd, you can make $1,000, no problem. If the price drops below 65, then you'll have to purchase the shares at $75. All right. So that's it. Again, to me, this looks undervalued, if only a little bit. So we're definitely going to go in and look at some options on options, and then decide if we'll do that or we'll just purchase the stock.